Welcome back to the channel. A lot to unpack this week. More changes coming for Canadians with mortgages at renewal time coming November 21st. We're going to discuss what some of these changes are, obviously go through some of the details, even with those 30-year amortizations for first-time homebuyers as we got some more info, as well as some of the changes for that 1.5 million new purchase price for insured mortgages. We'll unpack the details, share our thoughts and opinions on these changes this week. But first, we welcome you back to the channel. If you have not subscribed, we invite you to subscribe to the channel, hit that notification bell. Don't forget to leave your thoughts, questions, and comments in the comment section below. Let us know what you think of these changes. And if you learned something in this video, don't forget to give the video a thumbs up and a like and a share. Let's get this content out to as many Canadians as possible. Now, let's get right into some of these details. First and foremost, earlier this week, we did get some news from OSFI, the Office of the Superintendent of Financial Institutions. Now, this is not really the biggest news in the world, but it is for Canadians that are approaching mortgage renewal after November 21st. So previously, what ended up happening was if you had a mortgage approaching mortgage renewal and you wanted to switch to a different lender because maybe you were getting a more competitive offer, you had to undergo the stress test to make that switch. Now, effectively, all Canadians that are approaching mortgage renewal will not have to undergo the stress test to switch their existing mortgage over to a new lender. Now, that does not mean you're refinancing or taking equity out. It is basically switching the same mortgage balance from lender A to lender B. Now, previously, this was also open to insured mortgage. If you had an insured mortgage, you put less than 20% down, you paid the insurance default premium on that mortgage, you did not have to undergo the stress test. Now it is opened up to all Canadians. And this is really good news for Canadians that are approaching mortgage renewal because they have options. They don't have to stay with the same lender. Sometimes they had to stay with that lender because they didn't qualify to switch over to a different lender because they had to undergo the stress test. And based on that, they weren't able to get more competitive offers. So as an industry, we've been definitely fighting for this. And finally, OSFI has decided to grant this particular change, which I believe is going to make banks more competitive to keep existing clients and be really aggressive on those rates because now the client has the opportunity to leave. Now, obviously, that's one set of changes that are coming out amongst others that came out last week with the federal government announcing 30-year amortizations for first-time homebuyers, increasing insured mortgages to $1.5 million. Now, we talked about it last week, but we have some more details this week. The definitions of basically who is a first-time homebuyer. So there are three sets of criteria. One is that you should have not owned a home or you don't own a home. You've never bought a home. So you're a first-time homebuyer. Now, obviously, this should come as common sense. But the second one is sort of interesting because they've now said, okay, well, maybe you own a home. Maybe you had a property, you were on title, it was your primary residence, but you haven't owned it for 4 years. So if you haven't owned it for 4 years or more, you are now eligible for the 30-year amortization. And the third one is obviously through marital breakup or common law breakup, where if you're going through a separation and you want to buy a home, you don't want to wait the 4 years, but you need the 30-year amortization, you can do it right away, providing each one of these options is all providing you qualify for the mortgage. So we now have a set of criteria for the first-time home buyer. I mean, we're expecting these rules to be very similar to a lot of the other programs. Remember, keeping in mind that 30-year amortization was originally initiated back in the budget in April. That was brought in and tabled for by the Liberal government for first-time home buyers that were buying new construction homes. So that's very important to think about. That rule was the segue to make the change for all first-time home buyers. Now, we'll get into our thoughts and opinions in just a moment. I want to go over the changes from 1 million to 1.5. Obviously, we thought, hey, you know what? They're probably going to put in a different sliding scale here, from up to 500, 5%. Anything over that, maybe 10 or 15, but they left it alone. They didn't change anything. They first 500,000, 5%, that's $25,000. Anywhere from 500 to 1.5, 10%, that's 100,000. Effectively, you can buy a home providing you qualify with as little as $125,000 down. You can buy up to $1.5 million. Now, ultimately, that might be a stretch. Some Canadians, obviously, looking at that income, you need roughly around $300,000, $310,000 to $330,000 plus income, household income, combined income. I mean, that could come from you, your partner, you're as a couple, mom, dad, aunt, uncle. I mean, you can add several people to the deal to make it work. But ultimately, this is literally the question as Canadians are wondering, hey, who's qualifying for this or who could qualify for this? But I think most Canadians, I mean, stretching it that far is literally the question. That's why a lot of people were talking about this. So stretching the budget to 1.5, 30-year amortizations, I want to just retreat back for one quick second and sort of explain this. For insured mortgages, many Canadians believe that the 25-year amortization, which up until December 15th is the case, it's still what is happening. Effective December 15th, as of December 15th, you can go 30 years. Prior to that, you had a 25-year amortization. The insured products were not just for first-time home buyers. I mean, this was just called the default insured program, which means you can buy a home with less than 20% down. We sort of positioned it as first-time home buyers, but interestingly enough, it's sort of interesting because now they're making sure that the 30-year amortization is for first-time home buyers, while the default insured program, the 25-year, is still sort of open-ended, right? You could still own a home. You could buy a home. Let's say you own a home and you want to buy another home and you're going to rent out the previous one, but buy the second with less than 20% down. As long as that home is your primary owner-occupied home, you can still buy with less than 20% down. So you just can't take the 30-year amortization. Now they're talking about that 1.5. Well, it doesn't say insured mortgages up to 1.5 only for first-time home buyers, right? It says insured mortgages are changing from 1 to 1.5 to accommodate obviously affordability in some of these hotter pockets like Toronto and Vancouver, where home prices tend to be, a little bit north of $1 million for certain types of homes. So this is really interesting how this conversation is playing out. Now, I want to take it sort of full circle because being in the industry, as I mentioned, 15 years plus, we've only seen regulations get stricter and tougher on first-time home buyers, tackling the demand side of the equation, making it more challenging. And ultimately, home prices still continue to rise. Now, they're ultimately easing a lot of these changes, right? They're making it easier for first-time home buyers to take on more debt, pay more interest, incur more leverage. And on top of that, we have interest rates that are now retreating. We have the Bank of Canada meeting on the 23rd with a potential rate cut of, for sure, at least 25 basis points, maybe even 0.5%. Some economists, some analysts are saying, hey, we might see 50. We might see a monumental move by the Bank of Canada as the economy, the Canadian economy, the landscape here continues to worsen. So what is that going to do to buyer sentiment, the psychology in the market? Is it going to move the needle? You have builders that are not building. Remember that 30-year amortization we talked about was originally designed for builders for newly constructed homes and first-time home buyers. Now they opened it up to everyone. What other changes are we going to see happening proposed by either OSFI, the Liberal government, as we look at what's going to happen potentially over the next little while? Is there going to be a snap election? Liberals are failing in the polls. I mean, what is going to happen here? I really think, and this is something that we've talked about on the channel before, where Canada is obviously a housing economy. We need construction, we need builders, we need developers, we need permits. All this money that is generated is coming from the housing sector. And as it is a huge component of the housing sector, can the federal government, the Liberal government, any municipal government afford housing to collapse, to lose this lucrative part of the economy? And literally, this is going to be the question moving forward, because as we look at all these measures, we've looked at, just taking us back to the pandemic with the fact that they were able to, during the pandemic, you could defer your mortgage so that you can stay in your home. All these changes for the Bill of Rights, the Charter for Mortgage Rights, all these things point me to the direction that the government really does not want housing to fail. Not to mention the fact that Trudeau came out not too long ago actually saying the loud part quiet and the quiet part loud.
Yeah, Justin Trudeau actually might have said the quiet part out loud when it comes to housing during an interview with the Globe and Mail. Take a listen.
But housing needs to retain its value. It's a huge part of people's potential for retirement and future and nest egg. So yes, we need to keep housing stable and valuable.
They came out literally telling us that home prices need to stay elevated, right? So I really think there's a lot of people out there that are saying, we need home prices to come down, interest rates, so on and so forth. And I do believe that obviously home prices are elevated right now for a lot of first-time home buyers. The question will be is ultimately how will all these forces really play out into the economy? Remember, Bank of Canada is cutting, fixed rates are dropping, builders aren't building, we need homes, we have higher immigration levels, right? We definitely have now looser policies, regulations for mortgages for first-time home buyers to get into the market. That's going to obviously push home prices potentially up. It's going to maybe motivate sellers to wait till after December 15th, or some first-time homeowners to buy now and close after December 15th to get ahead, to front load the market, because the homes that are originally priced to $1 million or less had a very specific buyer pool. We talked about it last week, and it's very important to reiterate. Million or less, you had buyers that maybe had 20% and didn't have 20%. As soon as you got to the $1 million threshold, you needed 20%. Now, to go from 1 to 1.5 million, you need 125,000 and a very strong income, of course. But is this going to move the needle for the real estate market here in Canada? Are we just set up to have this whole thing basically rebound upwards and onwards? And will this impact the Bank of Canada's future rate decisions in 2025? I mean, as we go through this journey, we're unpacking all this together, and I want to get your thoughts and opinions on it. So make sure you leave them in the comment section below. Make sure you subscribe to the channel. We'll be doing some updates on this in the weeks and days and weeks ahead. So thanks again for stopping by. We'll leave the video here. Wishing everyone a wonderful Friday and an even better weekend ahead. Thanks again for stopping by.